Cool, guys, let's get going. I see there's still a few people hopping on, but we've got quite a bit to take you through this morning. So, welcome everyone to this special edition monthly coffee session from Seed. So, I hope you all booked an hour and 15 minutes in your diary. I hope you saw that. Today's session is not an hour, it's an hour 15. The good news is that for that hour 15, you'll get a full CPD point. So please do make sure that you stay on for the full session so that we can give you your 1 CPD certificate. And as you can see from the invite, special topic today, we get so many questions around Bitcoin and cryptocurrencies, especially when Bitcoin rallies. When it pulls back into a bear cycle, less so. But I guess the same is true for you from your clients as well. And we thought, let's just take some time today to try and give you guys some insights, just an IFA guide, if you like, on Bitcoin. We're not experts ourselves. We're still exploring this whole world of cryptocurrencies and what it means for all of us. But Ian has done a lot of work on this, and he's going to share some insight around that today. I think at the same time, the markets is in absolute turmoil at the moment. So Ian will start with a few thoughts on that as normal, just to position what's happening in the marketplace. But before we kick off with all of that, I just want to thank each and every one of you on this call, all our business partners, for your continued support of Seed and our solutions. We've just finalized our 2025 financials, and it's been our most successful, most profitable year in history. So we're super excited about that, and we're happy to celebrate that. And we can only do that because of the continued support from all of you on this call today. So thank you for your partnership and your support. And I'll take a bit of liberty and just also remind you to go and look at the Seed Fund performance. Really stellar performances over the last 3 years across the Seed range and solutions. I think solutions you can use with confidence in your client solutions when you build their portfolios. So on that note, Ian, I'm going to hand over to you to have a look at the market and then lead us into the Bitcoin world. If you do have any questions, you're welcome to post it. You're welcome to put your hand up. There will be time at the end also for questions. We've allowed that last 10, 15 minutes for questions, and we expect you might have some questions around Bitcoin. Thank you, everybody. Enjoy the session. Great. And Ian, thank you.
Awesome, guys. Thank you, AD. And yeah, welcome, guys. So yeah, as AD said, obviously this session a little bit different. We're going to just spend just a quick market snapshot. I've got a couple of slides on that. Obviously, we went in. Just go back a little bit. Yeah. So just a quick on the market snapshot, and then as Eddie said, there's quite a lot of volatility in the markets now. We'll just look at that briefly. But yeah, the thrust of the session is an education session. It is on Bitcoin. So I've sort of broken up into 3 components: Bitcoin basics. So there's a bit of technical components around this. Trying to look at it in more layman's language, but trying to give some groundwork, and then a couple of slides on the monetary properties of Bitcoin, and then Bitcoin as a financial asset. So yeah, there's quite a lot of detail, but we've tried to keep it as simple as possible. But yeah, hopefully we can answer a lot of questions and get some groundwork for everyone. And as Eddie said, it's a learning curve for all of us, and this is what it's about. So yeah, let's go into some of the slides on the market. We put this up. This is up till the end of February. Obviously, we've had quite a run up and volatility into March already. So this doesn't actually even if we look at the year to date for February, up till the end of February, doesn't even paint as clear a picture as what we've really seen. We've seen the S&P there up 1% February, but it's come off a lot into March. And so we've seen this rotation, and I've got just a couple of slides on that. And it somewhat goes to what we were discussing last month, with the US being very expensive, and so those magnificent 7 stocks have come down quite a bit. And what has pulled up is obviously China, emerging markets, and Europe especially given the geopolitical turmoil. We've seen that also rally into gold. I mean, gold up 9% there. It's rallied up into March again. So we're up at new highs on a daily basis. And I'm sure you guys would have seen that. So that's painting a picture of maybe the geopolitical concerns in the world. The JSE has had a good run, and that's largely due to a lot of the metal stocks. Gold as well, obviously, platinum. So the resources have done exceptionally well there. And then the topic of today, Bitcoin. Well, that's been a negative, down about 10%. And I think that's pretty much where we stand at the moment for year to date. Also, that's agree to a certain extent. It's because I think the market uses that or sees that as a technology, and so you can it's been sort of lumped together maybe somewhat with the Magnificent Seven. So it is a volatile. I've got a slide on that. We know the volatility. We can see those numbers in the past: huge up numbers and huge down numbers. And then you've got the Nasdaq. Well, I mean that's taken a knock. So all in all, a lot of volatility this year. At least we've seen reasonable. The currency has been reasonably steady, which is great. Especially given all the geopolitical concerns with the US and SA. So a little bit of a picture, but yeah, as I say, March has been even more volatile, as we know. So if we look at a couple of the slides, this one on the right there is from BCA, and they try and track trade policy uncertainty, and at certain points in time, policy is very steady, and the market knows where we're going. And at times like now, a huge amount of policy uncertainty, and we've all seen it. It's making headlines, where in terms of especially clearly these tariffs as a major a point of policy that Trump is putting out, but it's up and down. So this creates a huge amount of uncertainty, and markets don't like uncertainty. Clearly, we all know that. But in many times in the past, when you've got this huge amount of uncertainty and sell-off, it often does point to a good entry point. So we mustn't be concerned when markets come off. We know that they don't go up in a straight line. The chart on the left, the column on the left, it gives a sense of all the various market experts. These are the strategists that are surveyed, and where they see the S&P at the end of the year. And it's a big divergence. Some are looking for another 18% for the S&P this year. Middle of the range is 10%, and then some, like the BCA, which we follow, are the most bearish. They're looking for a 25% correction. So they've been bearish for a long time, saying that the US is heading for a recession, and pointing to the fact that the market should come off quite steeply. They remain pretty bearish, and then they're right at the bottom of the pile there. So we take their views, we look at their views. I think there's been a large degree to which their concerns have been, there's validity in their concerns, mainly given the expensive markets, and I think we've seen that a little bit now in these last few months. And there's been a big divergence between the performance of US, especially those tech stocks, and some of the emerging markets, China especially, and some of these European defense stocks. So again, I think this just gives a sense of, even on the strategist, there's no clear outlook. So you've got to you've got to look at this and figure, okay, well, not always so simple. We've got to try and allocate with these views, and you've got to go with some of the views that you think make the most sense, and that's the job that we have. If we look at the next slide, this gives on the left. This is again from BCA, and they just basically give us this asset allocation to say, okay, where should we be allocating? Should we be a midpoint for equities, or overweight or underweight? And they've been underweight for quite some time. So basically saying equities in general are expensive. And then if we look at the at the regions, the US particularly so. So just more recently, they've downweighted the US from an overweight to an underweight position, and overweighted places like Europe, and the rest of the countries more midweight. So that's good. I think up until more recently, their bearishness hasn't really paid off, but it's starting to play off now. We can see that chart on the right where it's tracking from 2020, the S&P 500 relative to the MSCI, and it's been almost like a one-way bet. But the sharp pull down in the last bit of time there gives an indication that there's this sort of market rotation, and time will tell whether this is just a sharp pullback and we continue up again, or this is this is a proper rotation out, and we'll have to see how this plays out. I mean, I think the big thing that we've said with the S&P especially is the fact that you've got expensive stocks. It's very expensive and it's very concentrated on the Magnificent Seven, and those are the ones that have pulled back. I think if we look at our portfolios, we've been very underweight those areas, so we haven't always got the run up, but at least now there's a degree of protection which is starting to come through. So that's just some thoughts there. If we look at the if we look at South Africa, I think I've just got one slide, and that's just on the budget. These are courtesy of Net Group. Pulled out some nice stats just some nice charts anyway, just on the budget. We obviously know it's been an area which has been very contentious, and even where we stand now, there's some degree to which the DA is not happy with obviously with this budget. It's I think there is a degree of concern in terms of the government continue to run very high deficits, and we can see that on the first chart there. For the last 15 years, very high deficits, over 4%, and so that's obviously really racking up the debt. And governments do that. South Africa is not the only one, no question about that. But I suppose it's a matter of where does that money getting spent? And the chart in the middle gives a sense of the interest cost in nominal terms. It's ratcheted up a lot. I mean that's it will naturally, just as the numbers increase. But then as a percentage of income, revenue generated by the government, it's also steadily moving up. And so what you have is a situation where the government is spending a lot on interest, spending a lot on other things as well. But I mean, the interest cost on the debt is very high. But as you've always got to look at the opposite side. And so even when it comes to the budget deficit, that money is someone is the recipient of that. And we know there's a lot of wastage in the system. But again, wherever it's landing, it is generally getting spent. And if we look at the interest cost, we being investors, and we've said this for some time, are the recipients of that. So while the government, from a tax take, has got to spend a lot on interest, pay high interest costs because of its debt, someone should be taking advantage of that, and we have been taking advantage of that by allocating money into bonds, being the recipient of those high interest rates, and that has obviously helped portfolios and helped our clients, and we've got to continue watching it. What you want is high interest rates as an investor. Clearly, you just want to make sure that the government will continue to be able to pay that, and it'll be paid back in reasonably valuable currency over time. So far so good. I mean, bonds have been a reasonably good place to have been, but there's a degree to which we just got to keep monitoring that. The chart on the right shows the fact that this is the total year-on-year increase in expenditure. So it's a percentage increase in expenditure, and for the last few years it's been stepping up. In this current budget, 7.8%. So big increase in expenditure, and I think this is the big one that obviously the DA was not happy about. Saying, look, there's been very little that the government is looking at in terms of trying to reduce down expenditure. They're just basically saying, well, we've got to spend, so we need to find the money. And so we're going to find it from the VAT and also find it from the tax tables. I think that's one that's just underappreciated, the fact that they haven't moved the tax tables. So we know that there's a large degree to which the taxpayer in SA is getting squeezed as the government spends money. So we'll have to watch this. I mean, it's interesting clearly, and it does have an impact overall on the economy. So anyway, that's just the one slide I thought I'd have on the local local market. So yeah, if we look at the overall position, I think there's no question. There's a lot of geopolitical risk. It makes a lot of news. A lot of trade and economic policy risk and remains high. Companies and markets don't like it, but there's no doubt that it will settle down, and companies are constantly trying to figure out and look ahead, and they do a pretty good job of that. So there's no doubt in my mind that things will settle down from a policy risk and an economic risk perspective, and then the markets will find their sort of equilibrium point. So you cannot get overly concerned about it. There's no question that there's a degree of rotation, which is a very good thing, because markets can remain expensive for a long time, but you sort of want them to come back a little bit, especially when you've been out of them. And as I said, we haven't really been an investor that has chased up those Magnificent Seven, and they've been moving up such a lot. So it's almost it's almost a very good thing to see a little bit of a proper pullback in some of those very expensive stocks to more value, the Europe, China, and emerging markets, which has been really good to see. I think some of the policy that's coming out of the US government is that they've also got this fiscal spending problem, clearly. They want to see interest rates down, and they seem to have made it their policy. They want to see private lending up. It's no good the government borrowing crazily without private lending. So they want to see private lending up, and I think a big factor for them is trying to get interest rates down. We're going to have to see how that works out. But Scott Bessent is the new Treasury Secretary. I mean, this is one of the comments that he made, and I think it speaks to somewhat to some of their views. He's saying, well, this is one of the comments. The market and the economy have become hooked, become addicted to excessive government spending, and there's going to be a detox period. So we'll have to see how that plays out. They seem to be reasonably not overly concerned about the current market decline. We know that Trump does look at the stock market, as one of his key performance indicators. So at some point, it might get very difficult for them if it really does become a problem. But so far, they think that a bit of a pullback is positive. I mean, if you listen to Scott Bessent, I mean, he's been in the markets for 35 years. He understands these things. Comes from a hedge fund background, and he says, look, the markets cannot go up in a straight line. We all know that. Pullbacks are good and healthy. If you look at the local market, I think just one factor, and that just again is on the interest rates. Lenders to the SA government continue to benefit from these high interest rates. The government is squeezed from a tax position. We've seen this with them having to hike the VAT rate, and then obviously having to not change tax tables. The fact that tax change the tables without altering them for the inflation rate is expected to take in more tax this next year than the 0.5% increase in the VAT rate. So they really are squeezing, but as I said, we continue to benefit as lenders, and we always have to be careful, but I think we are seeing that these high interest rates are very attractive still. So those are just a few points on the overall market. If we look at Bitcoin, okay, we've got a couple of, I think we'll start with a couple of polls. We've got 2 questions here. Okay, yeah, before we get to the questions, I think this gives a bit of a sense of why we want to look at it. So Carmen pulled these out for us. Some hope Bitcoin would just go away while others embraced it. So let's ignore it. Let's explore it. And I think we're getting to the point where we've got to start exploring it. If you look at the more serious money, these are the more serious bankers, and this is where it is globally now. Large banks and investors are now starting to take Bitcoin seriously. And the little payoff line is there. We need to rethink our strategy of hoping Bitcoin will just go away. It seems to be the case. It's obviously been around for 15 odd years now, and clearly Wall Street started getting into it in a big way last year, and we've got some slides on that. And so I think this is where we find ourselves, trying to understand this thing, trying to see if it does start making sense. There's a lot of regulatory issues, obviously, locally, globally, in terms of how this needs to be included, what hoops and that people need to jump through. And so there's a lot to consider here. But that's why we thought let's try and get into some of the basics and hopefully answer some questions. So I think we've got a couple of polls just to give a bit of a sense. So maybe we can put that up. Hey, have your clients been asking you about Bitcoin all the time, or occasionally, or not at all? Yeah. Yeah, I think that makes a lot of sense. I think, as Adi said earlier, I mean, it ebbs, and wanes in terms of when the price is ratcheting up dramatically. Maybe there's obviously a lot more curiosity and questions coming, and when it pulls back, there's very few. But yeah, that probably makes a lot of sense. Not a major focus, but occasionally there's people, and for some, there's a lot more active questions coming from clients. I think that's it. Have we got the next poll? Yeah, rate your own knowledge on Bitcoin. Beginner, I've heard about it. Intermediate, to understand Bitcoin, how it functions, but I haven't invested. Advanced, I actively invest and understand its technical aspects. Oh, okay, great. More of a mixed bag here. So the bulk is obviously, heard about it. We've all heard about it. Don't really understand it. And intermediate to understand it, but haven't invested. And then some advanced have invested in it, understand some of its technical aspects. That's great. So yeah, that's great, guys. I think we can get some. There should be some good questions that come out of it, and it looks like I might have to ask some of you to help me with some technical stuff. All right, let's get into it. Okay, so if we take a step right at the step from the start, so the genesis of this was Satoshi Nakamoto, who produced a white paper on Bitcoin, and he titled it "Bitcoin: A Peer-to-Peer Electronic Cash System." In the opening commentary, basically saying in the preamble, he was saying we need a solution to take to avoid some of the problems with the banking system. And then he said, what is needed is an electronic payment system based on cryptographic proof instead of trust. allowing any two willing parties to transact directly with one another without the need for a trusted party. So it's a 9-page white paper on Bitcoin. He released this paper in October, end of October, onto various chat forums. He had obviously already produced all the technology behind that, and then put together the white paper, and then released the white paper, which sets out the technical details. So effectively, it proposed a system for trustless electronic transactions. So it's really, what is Bitcoin? It's really a system to move transactions from one party to the next without a need for a third-party intermediary, typically a bank in the middle. And we'll go through some of that. So he released the paper in 2008, October, and then in January 2009, he released the open source software. So it is open source. Anyone can download the software. Anyone can start mining it and validating the transactions. And so I think that time span is also important, because he didn't, there was no pre-mine. He didn't get a whole lot of Bitcoins by himself or for himself without at least publishing the documentation and the software into the public domain. So only from January 2009 were Bitcoin starting to be produced. Okay, so that's the white paper. You can find it on bitcoin.org, and it's worth a quick read through. There's a lot of technical aspects, but it's worth going through the detail. So in its basic format, what is Bitcoin? It's a distributed ledger. If you've got any degree of accounting knowledge, a ledger is simply, like on the left, it's who owns what. So you've got a ledger, you've got Dave, Alice, Bob. Each of them we own. I've got $5,000. I've got $2,000. Got $3,000 in my bank account. Bitcoin says I've got 12 Bitcoin. I've got 500 Bitcoin. I've got 3 Bitcoin. So in its basic format, you can just think of it as a ledger. It doesn't actually show balances. It shows transaction inputs and outputs. And so it'll show, let's say, 10 units of Bitcoin, or 10 Bitcoin. Maybe you've got them stacked as 5 Bitcoin, 2 Bitcoin, 2 Bitcoin, 1 Bitcoin. So it's almost like, 5 Rand, 2 Rand, a 5 Rand coin, a 2 Rand coin, and a couple of 2 Rand coins, and then a 1 Rand coin. But in its basic format, it's a ledger. And the big thing about this ledger is that it's not sitting on one bank. So if you think about it, each bank has got their own ledger for all their client base, and then the next bank has got their own ledger, and the next bank. And around the world, you've got all the banks with their own ledger, and then they're interacting. But what this ledger does is it sits on the right-hand side. It's actually distributed across thousands of nodes. In fact, it's like upwards of 20,000. So anyone can just download the software and then download the particular ledger. It's actually apparently not too big in size as well, because it's pretty compressed data. So you've got hundreds and hundreds, thousands, in fact, of copies of this ledger. And so that's the big distinction between a bank ledger and the Bitcoin ledger. And that's how you got to think of Bitcoin, as this distributed ledger of ownership across all these thousands of nodes. They're called nodes, but essentially a node is just a computer who's got the software and then has got the software, and that reflects all the ownership transactions. So it's not just the ownership at each point, it's actually the transactions as they get updated. Okay, so that's in its very, very basic form. All right, then we get to this concept of mining, Bitcoin basics, proof of work or mining. And I think the big issue is, because it's not a centralized ledger, the big question is, and this is the big thing with Bitcoin, who gets to update the ledger in an agreeable manner? But if you've got all these copies, you don't have one central party who says, I'm the determining factor as to who is going as to updating this ledger with each transaction. How are you going to get to an agreeable or consensus for updating this ledger? And that's where Satoshi introduced this concept of proof of work. Now, he didn't develop this thing called proof of work. He actually cited Adam Back, who is a technologist and is still around. and out there. And he cited his work on this concept called proof of work. So this is where the concept of mining comes in, and I know it can be a bit confusing, but let's go through it. So the process is referred to as mining, or more accurately, it's proof of work. And the process is required to determine who gets to update the ledger for all the valid transactions. If I want to send a transaction from myself to Mike, who gets to update it? If I send it on one bank, the bank will update it. The bank is the central party. But now you've got this ledger, which is just replicated over thousands of computers. So how do you get to update that? And so this is the consensus mechanism called proof of work. Effectively, what happens is proof of work is in it's actually quite a simple concept at its core, and that is what you've got is you've got a puzzle that is very difficult to solve. The miners solve this puzzle, but it's very easy to check. So the nodes, all the different computers who are running the Bitcoin software, but not miners, they do the checking. It's a very simple calculation to check. It's super quick, but exceptionally difficult to find. So what happens is proof of work, the computers essentially, all they're trying to find is a random number. It's called a brute force process. So there's no other way for them to come up with the clear solution for a bunch of transactions, and we'll go through that, but to find this random number. And it is purely a random number that meets certain criteria. And you can think of the miners, all they're pretty much doing is literally rolling a dice. You can think, let's say you've got a dice with a million sides, and at each point in time, the difficulty changes. But at this point, the difficulty says you need to find a number between 1 and 200. Okay, it's as simple as that. And so they roll the dice and they get 550. They roll the dice, they get 620. They roll the dice, they get 3,000. They keep on rolling the dice, and eventually one miner rolls the dice and he gets a number 199. Well, now he's got the number. It might take them a long time. It does take them a long time to roll that dice and find the number. But then the node will check it and say 199. Yes, you got it. Okay, it meets the criteria. Good, you're good to go. And so that is the miner that wins the award of the new Bitcoin. So, okay, we talk about a dice with a million sides, but actually the difficulty is exceptionally high at this stage. And so the current calculation is all these computers out there are spinning, and the number of guesses per second is currently at about 810 quintillion per second. 810 quintillion is 810 million guesses per second, and then it's still taking on average 10 minutes to find the winning number. So it's exceptionally difficult, but all it is literally a random dice roll. And the 10 minutes is by design. So the system was set out that it would take computers, no matter how much computing power, roughly 10 minutes. So that's the idea. Sometimes it takes 2 minutes because it's purely random. Sometimes it can take 2 minutes, sometimes 1 minute, sometimes 8 minutes, sometimes 25 minutes. But the system is designed that on average, the time will be 10 minutes. And it's actually surprisingly accurate. So it's been running at about 9 minutes 55 if you look back over the last 12 months. So if we continue on with this concept, so once a new block of transactions is successfully mined, i.e., the computer finds a winning number, then those details of that block, all the transactions in that block, are broadcast to the network. They're validated by the node. The node validates, and it's actually a simple, easy process to validate. As I said there earlier, it's the node who runs the software, and anyone, because it's open source, anyone can download the software and run a node and validate transactions. That's not the complicated part. The more time-consuming part is the mining. And then once that happens, the block is added to the blockchain. And each block of transactions is linked together by cryptography. So why do these miners spend money? Because they're spending a huge amount of computing power to essentially find a random number. And it's because they are awarded with an agreed number of Bitcoin. So the system says if you find this number, it meets a certain criteria, you will get a certain number of Bitcoin. Currently, the number of Bitcoin is 3 1/8. So 3.125 Bitcoin comes out and they get rewarded with that. The system gives them a new set of Bitcoin plus the transaction fees. So there are transaction fees. And yeah, the current value is $265,000. That's what's coming out every 10 minutes. So on average, every 10 minutes, there's a winner, and the value of that is $265,000. So what you've got is that you've got the proof of work, which is the mining process, is essentially linking real world electricity cost to each Bitcoin mined or generated. And this has been described as the unforgeable cost of it, Bitcoin. So Bitcoins are not just manufactured by the push of a button. There is a cost, and there is electricity cost. Uh, it's mostly electricity. Obviously, there's computers. These miners have to spend tons of money on computing power, setup, and everything. But the big cost is obviously the electricity cost. So that, I know it's a complicated process, but that's the nub of the mining process. If we go to the next slide, this little thing on the left is just a graphic of a block of transactions. So anyone can, as I said, it's open source, and because it's open source, there's a lot of different applications on the internet, and this one is called mempool.space. So it actually tracks all the blocks coming out, and this gives a little graphic. So that graphic, all those little blocks are transactions in that particular block. So that happens to be block number 887910 that was mined. So someone found the winning solution to that block, and I've just highlighted one little transaction there. Maybe you can see it as like a tiny little blue spot. That someone transferred 14 Bitcoin, 14 and a half Bitcoin, and they paid a fee of 36 US cents for that equivalent for that. And so anyone can go and see, as I said, because it's open source, there's a lot of these different tools on the internet just to go and see the blocks, effectively the blocks being mined and what's in the block. And it's all public domain, so anyone can see the transactions going through and the full history from number 1 block up until number 887. I think we're on 888 now. So every 10 minutes, a new block of transactions is coming out. The chart, the little graphic on the right there, is just also graphically indicating that everything in one block is cryptographically linked to the next block, is cryptographically linked to the next block. And that's why it's called the blockchain. Satoshi didn't name it the blockchain. He called it the timestamp server. But essentially, each block of transactions is linked to the next. So there is no way that a transaction can go and be altered in a block in the past. Once that transaction is through, it is 100% cannot be altered without altering everything ahead of it. So it's pretty secure in that respect. We go on to the next slide. The other component of Bitcoin is this cryptography, and cryptography is obviously where we hear the name, cryptocurrency. That's where cryptocurrency comes from. So really, cryptography is really a technique that's to secure messaging between parties. And again, this wasn't developed by Satoshi. And I've got the point there. This technology in various formats was initiated by people even into the 70s, 80s, 90s, and there's different components to cryptography. But what Bitcoin uses is private public key cryptography to make and verify transactions. So you've got all these participants, and with the private and public keys, there's 3 elements that are linked together. You've got the private key, the public key, and then addresses. And private keys are, for the most part, a very, very super long number, purely random generated number. And then from the private key through a mathematical formula, and if you look at the graphic at the bottom, First of all, a private key, as I say, is just this purely random generated super long number. And then through a mathematical formula off that, it generates the public key. And through further mathematical formulas, an address is generated. You can think of the address or the public key as almost like your bank account. You can free to give out that bank account to anyone. Anyone can look at that bank account. In fact, you have to give out that bank account if you want money to people to put money into your bank account. So you give out your bank account, you give out your public key, it's public. You give out your address, it's public. But the private key is 100% private. It's obviously like your password to your bank account. If you give out your password to your bank account, you know that people will access your funds. And in the same way, that's how Bitcoin cryptography works. So your private key is kept secret, and it's used to sign transactions and to prove ownership. So it proves ownership. So it's like your PIN. The public key is derived, and you can share it. And because it's called a one-way mathematical function, it's impossible. The computers, no one can go back from your public key or your address and find the private key. So the strength of the private key is exceptionally good. But clearly, it's the same as as you having a PIN for your bank account. If you go and give that out to anyone, clearly then it's compromised. And it's in the same way that's the case with your private key. So in a basic format, this is what it does. This little graphic on the bottom shows some of the technology used to get from the private key to the public key. There's two forms of cryptography: elliptic curve manipulation. It's a hugely complicated mathematical function. I do not know how that works, that's for sure. And then there's a further mathematical functions. For the most part, it's the SHA-256, which is a well-known cryptography. It's used by a lot of banks and all sorts. And it's, again, these were not developed by Satoshi. He didn't develop all of this. He used all this that was in the public domain and put all this together. Effectively pulled all these different components together. So SHA is secure hash algorithm. So it's a well-known cryptography methodology. And so this is the security. This is the components of the security that you've got with Bitcoin transactions. So that's a little bit of a nutshell. Okay, then how do you transact in Bitcoin? Okay, we'll go through it step by step. So essentially, yeah, Bitcoin is really you signing a message with your private key. As I say, it's like I've got my PIN to my bank account, and I'm transferring money from one person to another. So I need to go into my bank account. I need to put in my PIN. It's the same thing. I've got to go onto the system and put in my private key. The private key says, okay, I own those Bitcoin in that public address, and I want to transfer ownership from one address to another. As soon as that happens, it doesn't mean that it's unlike the bank account now, because who sits on with one ledger. Because there's multiple ledgers, once you sign a transaction, it doesn't mean it's automatically validated. No, those transactions all go and sit waiting to be validated. And they sit in this whole memory pool. So at each point in time, there's hundreds and hundreds and thousands of transactions sitting, waiting to be validated. And now this is where the miners come in. They go and look at all these transactions, and they aggregate a whole lot of transactions, unvalidated transactions, and they put them into a block. And then they start looking for the solution to that block. As I say, that's where we spoke about earlier. So they try and find this random number that will meet certain criteria together with the transactions in an unconfirmed block of transactions. And so they're wearing up their computers, and they're trying to find this proof of work, effectively this random number. And when they find the solution to the block, they immediately transmit that block out to the network and say, hey, we found the solution. The nodes are the other computers. So anyone can run a node. As I said, there's about 20,000, upwards of 20,000 nodes around the world. They just validating transactions. So they're keeping the full transaction history of the Bitcoin, and as blocks are generated. And they're quite simply a matter of the this code saying, does this block meet meet the criteria? Yes or no. And that's a simple thing for them to say, yes, it meets the criteria. So the miners acknowledge that the block is valid, and then they start moving on to the next block of transactions. So as I say, every 10 minutes or so, it's getting updated. But because it's a random process, maybe a block is found in 1 minute, maybe 10 minutes, maybe 5 minutes, maybe 25 minutes. So that's how the transactions are transmitted. If we look at other basics, we've got what are called wallets. The wallet is essentially something that has to hold the Bitcoin key. It doesn't hold the actual Bitcoin. It actually firstly generates a key and then stores that key. I mean, that's all it does, because the Bitcoin are sitting on all these ledgers around the world on different computers. So all a wallet does is generate a key, and anyone can. Well, I mean, there's thousands and thousands of different wallets that just generate a key because it's purely a random number. So you've got private keys that are needed to sign Bitcoin transactions, and the private key controls the coins associated with that private key's address. So those are the ones in the public keys. So you've got different types of wallets. You've got what they call hot wallets. These are essentially just applications on the computer or on your cell phone. So anyone can just download a Bitcoin wallet on your computer or on your cell phone, and they're called hot because they always access. You're always on your internet and on your phone, so it's always there's that connectivity, which in theory does make it less secure. So that's why you've got things called cold wallets. Cold wallets are mechanisms where the private keys are maintained in secured locations off the internet. So they're not on your phone, not on your computer. So you typically think of something like a USB flash drive. So they're not USB flash drives, but it's that type of concept where you only, when you're signing a transaction, do you connect it up to the computer and then transmit the transaction over the internet. But for the most part, they are held off your computer or off your phone, hence the name cold wallets. And then the other mechanism, which is becoming more and more important in terms of holding Bitcoin, is via custodians. So the first two are where you can actually almost hold them directly, so to speak. And custodians are, parties like exchange traded funds, and we've got a couple of charts on that, or slides on that. So these are essentially independent parties that specialize in storing Bitcoin. So they will have their mechanism to store it. So those are some of the components of storage. Okay, let's take a quick look at monetary properties. So that's all of the basics. Let's look at some of the monetary properties of Bitcoin. Okay, so money needs to have certain good attributes, and it is debatable, is Bitcoin money or not? But if we just look at it in theory, money needs to be a medium of exchange. It needs to be a store of value. It needs to be a unit of account. It needs to be divisible. It's nice that you've got divisibility into smaller units. It needs to be durable. It needs to withstand wear and tear over long periods of time. It needs to be portable. I mean, you want portability in money. You want something called fungibility. That's interchangeability. You want it to be acceptable. You don't want to have your little type of money and no one accepts it. I mean, that doesn't make sense. Ideally, you want it to be stable so it holds its buying power over a long period of time, and that doesn't always work for money. But ideally, that's what you want, and you want it to be verifiable and recognizable. So those are all the good attributes of money in theory. So if we look at a chart and a comparison, so we've got this little chart. There's numerous of these. This comes from Fidelity, a big asset management business, which has obviously got into the Bitcoin side as well. And they're comparing some of those attributes and comparing gold on the bottom, Bitcoin in the middle, and fiat currency. So think of your rands, think of your dollars, think of your euros, and just some of those attributes. So durability, divisibility, fungibility, And yeah, I mean, you can debate some of these things, but if you look at gold, gold has been around for a long time. So it's got the best in terms of the right, in terms of track record. It's scarce. There's a high degree of scarcity in that. And that doesn't necessarily come with fiat, with your currency. Scarcity and long-term track record, because currencies come and go over long periods of time. The big problem with gold is it's not divisible. Yes, you can go down to a gold coin, but I mean, it's not, it's not really too divisible. It's not portable, and verifiability of it is not always the best. So anyway, they've compared this to Bitcoin. I mean, these are some of the attributes. Bitcoin does meet a lot of these attributes. It's positive in many of these attributes. Obviously, what is not positive on is track record. It's only got a much shorter track record, only about 15 years now. Gold has got thousands of years. And so gold makes good money. And then we've obviously got currency on the top. I mean, currency as paper, think about your paper rands, think about your paper dollars, so to speak, or even if it's in your bank account. I mean, you've got a lot of good attributes, clearly divisibility, portability. But I think that some of the big components that it hasn't got, and maybe the biggest one is scarcity, and that's the big thing with fiat. We know that they're expanding the money supply all the time. But if we look at Bitcoin as compared to gold, and and it's often been described as digital gold, and it has a lot of similar characteristics because it's non-income producing. It just sits there, and that's the same with gold. So really, what you've got is it's a pure supply and demand. There's no income that's generated off it. Satoshi, in the white paper, he compared mining of new Bitcoin to gold mining. So he saw, at least in that respect, there was a degree of comparison. And he said the steady addition of a constant amount of new coins is analogous to gold miners expending resources to add gold to circulation. In our case, it's CPU time and electricity. So there's a similarity between the Bitcoin mining and gold mining in that respect, and it has a lot of the similar attributes. So that's just some take. Here's another take. This is the supply growth of dollars and gold and Bitcoin. So we know that the dollar supply went up massively post 2020, and we can see that, and it's come back now a lot better to maybe 3.5%. But who knows where the long-term number is? So since 2020, it's grown at just shy of 7% in terms of the new supply of dollars, and that's largely, obviously, the post-COVID. We know what happened there, and that undermines buying power. We've seen that massively in these last 5 years. Gold has been steady, and it's been definitely one of its long-term positive attributes. Only about 2% of new gold comes into circulation. When I say 2%, it's 2% of the existing stockpile. So at each point in time, if you go back 1,000 years, 2,000 years, it's 2%. Only at certain times when they have a new massive discovery of gold, does it suddenly jump up, and then it creates this inflation. It has in the past created this inflationary impact. So gold goes at a reasonably steady clip of 2%. Bitcoin is going now currently at 0.85%. So it's actually come down below the supply. So it is capped at the 21 million, and we've got a slide on that. But it's only coming in a new supply of less than 1%. Okay, let's look at. So how do we get to this 21 million? So this chart gives a clear indication. So when Bitcoin started, every 10 minutes, 50 Bitcoin were generated. So for the first 4 years, half the supply, half the 21 million were generated. And that gave you 10.5 million Bitcoin. Then the system says every 4 years, it's pretty much on every 4 years. It's actually the certain number of blocks, which work out to be 4 years. The supply gets cut in half. So then it went down to 25 Bitcoin. So every 10 minutes, 25 Bitcoin. Down to 12.5. 4 years later, and now we in the era where there's only 3.125 Bitcoin popping out every 10 minutes or so. And so if you project that, it's going to take now over another 100 years. So where we are now, of the 21 million, there's actually 19.8 million of Bitcoin in existence, and it's going to take another 100 years to get the next million out. because the supply is going of the new issuance is coming out smaller and smaller and smaller. So this is the design of the release of new Bitcoin, and so it's totally inelastic. Unlike gold, let's say, where you put a lot more, where new mine is found, or you put you go and spend a lot of energy to go and extract more gold. No matter how much computing power is put to the system, the issuance comes out at a regular clip, and that's the design of the system. So 21 million will come out in total. The next chart shows this as well. So there was a steep curve in the start, whereby we got relatively quickly up to close to the 20 million, and now as I said, it's going to take the next 100 years. So this little halving chart gives a sense. So that's where we are now at 3.125, and it gets every 4 years gets cut. All of us won't be around when the last Bitcoin pops out, 100 years down the line, but that's the supply trajectory to get to the 21 million. Okay, looking at my time here.
Ian, maybe
Yes.
just on that point, there's a question from Wendell, and he's just saying, who set that supply up front? So that who's controlling?
It's in the system, so it's hard coded. So he set it up right from the very first release of the code, so it hasn't been altered. So the supply issuance schedule is set in the code, and so everyone is agreeing to that code and running that code. Anyone can develop another system which says, well, it'll come out differently, but this is the rules of all the current participants, and so it's hard set in the code. If we look at the monetary properties, so now we just get onto the monetary properties. So one of the last points is scarcity. So if you think about it, scarcity is quite a big one, and so and especially when it comes to digital. And this is a quote from Fidelity. They released this report, and quite interesting. They said before Bitcoin, there was no form of digital scarcity. Think about copying of digital files. We know that you can copy a photo 1 million times over. There's no scarcity in digital. But scarcity means there's a limited quantity of the asset in question. More cannot be created, and it's impossible to counterfeit. So one of Bitcoin's most novel innovations is its unforgeable digital scarcity. The fact that even though it's a digital, each Bitcoin in existence came about through the same rules and expenditure of computing power. And every Bitcoin that's created in the future will have to follow those same rules. In other words, nobody can fake a Bitcoin's existence or create more out of thin air. So if this fails, then Bitcoin does fail. So it comes back to that question from Wendell. I mean, if that issuance changes for whatever reason, then this whole experiment will fail. Because the supply and the fixed supply is paramount. Okay. So let's look at the last component. Bitcoin is a financial asset. I've got just a couple of charts on this. So this was an excerpt from the BlackRock report, also now in February. BlackRock is obviously very now entrenched as the biggest asset manager in the world into the Bitcoin space. And we've got some charts on that. And they said, for investors considering Bitcoin in portfolios, and I think this is a fundamental question. The first order question is, does Bitcoin have any value at all? And then the thinking can turn into questions such as sizing and implementation. So their report concludes, critics go to refrain is Bitcoin has no intrinsic value. To the contrary, in our view, the discussed embedded characteristics represent fundamentally real and attractive sources of intrinsic value, which we expect will be recognized by more people in places and in more places over time, particularly in a debt-laden, digital-first, and increasingly AI-entrenched world. So this is the fundamental question that obviously every investor has to look at. I mean, we are all investors, and we've got to try and understand when we allocate money is there value here? And that's a difficult concept, especially in a digital world. And these things are purely digital. But as I say, what people do forget, I think, especially with Bitcoin, which is not the case for every other cryptocurrency, because they have moved away from this proof of work concept, is that there is a linkage with each digital Bitcoin that's created to actually real energy and real cost. So there's a direct linkage there. So that's quite an important, a very important component. This is a long-term chart now of the share price, and this is also from BlackRock. And I think what's important here on this chart, which is that it's firstly a log chart. So you need to look at Bitcoin price in log terms. You can't look at it in a linear format. So a log chart obviously shows the orders of magnitude as the price went from, call it $1 price, up to 10, up to 100, and so on. And it shows obviously the massive move up in the order of magnitude, and then clearly the percentage drawdown. So we know the huge volatility in price, minus 93%, minus 84%, minus 83, minus 77%. But it has moved up in these orders of magnitude. Only time will tell whether it'll move from here, because it's moved over the $100,000. The next step in this chart should be obviously $1 million if the log continues. So you go from 10,000 to 100,000, 100,000 to 1 million. The supply is set, and so now really where does the demand come from? The demand is coming from obviously private investors, individuals, more so now ETF funds, and that's only been in the last year, so we'll look at that. Obviously a bunch of asset management firms around the world, but pretty small, I would say, in that respect. Family offices, maybe these are a little bit more because they've got ability. Some pension funds are maybe starting to look at it. Not South Africa, but I think globally they're starting to look at it. Some companies have obviously invested into it, and you've got companies, a few of them that have really started going in a big way. And then even obviously some countries, nation states, and obviously we've had the talk in the US about creating a Bitcoin strategic reserve. I don't know where that'll go. They do have some Bitcoin. I think they've got like 200,000 Bitcoin already from that they've taken from some criminals. And then so you've got all the demand that's coming. This demand, the biggest one that happened last year and saw the price move up, and I think it's quite an important one, is BlackRock. So this chart shows BlackRock's IBIT fund, which is the biggest ETF. So we've heard about ETFs, exchange traded funds. The chart on the right shows the massive growth, and we spoke about that last time, in terms of the amount of money flowing in to the S&P 500, the Vanguard 500, the VU fund, and the iShares, the BlackRock fund. And then third, in terms of flows last year, was the iShares Bitcoin Trust Fund, the IBIT fund. So huge amount of flows, huge amount of asset. This is to the end of the year, 51 billion. That has come down this year, both with some money coming, investors taking money out, and the price obviously down. So you're going to expect huge volatility. But I mean, this is a brand new source. And just to give a comparison to the gold, the next chart shows. Now, this chart on the left is BlackRock's gold fund, which started in 2005, and comparing it to BlackRock's Bitcoin fund, which was only launched January last year. So where we stand now, gold has done exceptionally well. So gold has moved up. But I mean, just shows you the long-term history for their BlackRock gold fund to get to that level, and the huge amount of demand that came in last year. So last year was big in terms of ETFs, which landed at, I think, about 100 billion. That's what it says there. And so this was a breakdown of some of the money. So hedge funds have been a big investor. Obviously, a large component there at the bottom, 60 billion of non-institutional. That's obviously just a range of private investors who are buying the Bitcoin via these US ETFs. And the BlackRock one is the biggest. But as I say, then the next biggest one is Fidelity, and then there's a whole bunch of others. And so that gives you some sense of just some of the demand, and that makes it easier for people to buy Bitcoin, where they're basically just buying a security. Okay. I think we're into the last chart, and that is giving a sense of, okay, and this is interesting anyway, I think. If we think as investors, we think, okay, what is the total market? So this is an interesting chart that was put together, and the estimated size of global wealth is about 900 trillion. And where is that all found? And it's found, the biggest block of wealth that people have around the world is obviously your real estate, and obviously a chunk of that, most of that is obviously for utility purposes. We all need a roof over our heads. Then you've got bonds, all the issuance of global country bonds around the world, and corporate bonds, estimated 300 trillion. Money, this is money sitting, that's created, obviously everyone sits with a high degree of just money in the bank accounts, 120 trillion. We've got equities at about 115 trillion. Obviously, all of these numbers move all the time, and there's no one 100% accuracy to all of these, but I think it's a reasonably fairly accurate 115 trillion. And that's probably about right, of global equities. And then you've got other assets like gold, which is probably about 20 trillion now. And art is another place where people store money. So that if you add all that up, that's 900 trillion. And so this little chart says, okay, well, how much can Bitcoin get? Because Bitcoin is a little little orange block, and its current market cap is about 2 trillion, just shy of 2 trillion. And so the estimate is, okay, well, if the total wealth is 900 and a quarter of that is 225, it's going to maybe nibble some from equities and money and bonds and real estate and gold. That's potentially where it can get to. Only time will tell. The chart on the right just gives a sense of the compounded annual growth rate. Obviously, this changes all the time. But over 1 year, gold has been fantastic, as we know. The stock market, as represented here by the S&P 500, on average, has been about 10%, 11%. We've had a good 5 year period, no doubt. At 18% or so. And then Bitcoin is volatile, up 20%, 2 years, 3 years, 4 years, 10% per annum. But 5 years, if you invested 5 years ago, you've got over 70% per annum. And so it goes. So, again, it just depends when and if you got in. It's very volatile. Many people get in at the high, and then it comes down dramatically, as we saw there, minus 90%, minus 70%. So it's very volatile, but this smooths out. Compounded annual growth rate has a degree of smoothing out. So if you look, let's say 5 years, 70% versus 5 years on the gold has been very, very good at 15%. 5 years on the stock market, US obviously has been very, very good at 18%. But that gives a sense of clearly of where that price has come from. So that's that chart, and I think that's it. Just some conclusions. So Bitcoin it's decentralized, it's peer-to-peer. So I think the big issue is you don't have the central each bank controlling. It's literally value exchange from a peer-to-peer, one person to the next person. It's important to remember it's totally open source with a growing number of miners and nodes and global users. It's got this built-in scarcity factor, this 21 million. That's the most important thing. It's got this fixed schedule of supply. And remember, each Bitcoin is subdivisible into 100 million Satoshis. So there's that subdivisibility to it. So you can think of each Bitcoin as a pizza, and it's subdivisible into 100 million little pieces of pizza. It is a speculative digital asset, but it does have this real-world cost attached. With no counterparty risk. So it's similar to gold in so many ways. Obviously, it's gaining popularity, and that's what we've got to consider. This $2 trillion market cap. Yeah, and I think this is the dilemma, and it's a dilemma for all of us. We've got to try and figure out. Both investors, financial advisors, will have to formulate an opinion and some type of solutions into the future for this asset. So I think that's it. And yeah, I'm sure there's some questions, Adi. We've got some time for questions, which is great. Thank you, guys.
Thank you, Ian. Yeah, there's been some questions that are running in the chat box, which you probably haven't seen, Ian, but we've been sort of attempting to answer those as we go. It sounds like Johan is crying about a few Bitcoins that he might have lost in a flash drive somewhere along the road. But yeah, that's unfortunately where the security of the system works against you.
Yes.
When you got that cold
Yes.
wallet and you lose it.
Yes. Yes.
Wendell had a few questions around who controls it, which Tawanda, I think, has articulated a good answer to. Any other questions, guys, that you have on Bitcoin or that your clients are asking you that you want to pose?
Yeah, I think it's important point is that, I mean, because that security works in, as you say, in both ways. It's very secure in terms of the private key, but if you lose that private key, no one can access those coins. You can't phone up anyone and say, well, I've lost my PIN. How do I recover my PIN?
So two
The
questions
mathematics
here,
to it.
Ian. So
Yeah.
Johan asked, as far as he knows, you're not allowed to deal in Bitcoin from a regulatory perspective. I'm assuming he's asking as an IFA. Maybe just answer on that.
Yeah, so this is, I think, the big issue here from a regulatory perspective. The FSCA has opened up this category for, I forget the terminology now. Do they use digital assets or do they use something else? They use something else. So they have opened it up now. So there is an element to which they are saying people can advisors can advise, and um, Cat 2s can start including it. But and they're classifying these things as EASPs. So you've got exchanges as well who also come into. So the regulatory environment is definitely opening up and has opened up to some extent. I think the issue is from a seeds perspective, we're still trying to grapple with this. It is categories which we don't have, which is why this session is purely an education session. There's no advice here whatsoever. We cannot give advice and we cannot include these products as yet. So even then, when you've got the regulatory, some of the debate is when the regulations relax it, maybe you've got additional layers. So if you look at the CIS funds, and then they themselves have got the unit trust funds have got there's regulations as to what you can include there, and then globally we run the UCITS funds, and then there's regulations as to what they will allow and will not allow. And then you've obviously got the deed. So that's been a big factor, and it remains a big factor. And so that's not a simple. So there's no simple solutions there.
Thank you, Ian. Yeah, there's quite a few questions around that. Reef just confirming there that as of 2023, you can get accredited to sell
Yeah.
these or to advise on these digital
Yes.
asset at a Cat 1 IFA level, that is. And you need to
Yes.
get that accreditation renewed annually. Chris
Yes.
asking if we're selling hedge funds, are we not by default placing clients into Bitcoin? Um, I think we're selling mainly long short hedge funds, I would guess. And as
Yes.
far as I know, none of those are holding Bitcoins yet, but I might be wrong, Ian.
Not that we've come across. I mean, we have obviously. I mean, the guys met up with a particular hedge fund that we've known in the past, and now globally deals in Bitcoin. But that's specifically a Bitcoin and cryptocurrency fund. To be honest, I would be, I would be very wary of so many of these things out there, in any way. So it's not something we'd want to go into lightly. That's for sure, even if it was available. And so, hedge funds in the SA format, I haven't come across anyone or we don't know of anyone that's investing into it. But it will come, I'm sure.
Yeah. So is it fair to say at this point in time, if a client wants to access it, there is global ETFs that they can access, as you've shown through the BlackRocks and the likes, and the SA market specifically, no formal vehicle yet to access it, except through sort of private wallets.
Yeah, that's exactly it. So there's obviously anyone, and I'm sure a bunch of our clients there's no question, have got it directly. And that's, there's a lot of exchanges that you can buy the Bitcoin and then download it onto your private wallet. Globally, I think the ETF, and we've seen it with the stock market, with the Vanguard funds and the BlackRock funds and the Fidelity, how much success they've had with with equities in the ETF space, and there's no question they're having huge success here now. And I think that's going to be definitely, if we had to look at it, I think that's both from an advice perspective and from inclusion perspective, that just makes the most sense. It's a properly regulated environment in the US, and when if and when we get comfortable from an advice perspective and a management perspective, that just seems to be a very good avenue. Effectively tried and tested.
And then perhaps the last question from Wayne is saying the impact of energy resources used to mine the Bitcoin, will that ever be a negative factor affecting the value of Bitcoin?
Yeah, that's a good question, because it's a question which has obviously been a perennial question in terms of the energy expenditure, but it's actually a positive. I think what the market generally misses, or so many people do miss, is the fact that actually the expenditure of energy is a positive, because the more energy that's expended, um, there's a direct correlation between that and the security of the whole system. So you have to think of the amount of computing power, which is pretty substantial at the moment, and it's escalated dramatically over the years. So obviously that's been charted as well. Is actually a positive, because it actually gives validity and strength to actually the network. So what is also, it's quite a fascinating thing, because obviously those miners are incentivized to find the cheapest mining sources, and they often find stranded mining sources. So you can find energy, let's say, sitting at a waterfall or hydropower, which is way far from the market, and it's just not sustainable or suitable or economically viable to get that energy via transmission lines and what have you to some source. But you can actually put these miners at the source of the hydro. That's what China did dramatically a lot in the last 5-6 years or whatever. And I'm sure they're still doing it. A huge amount of hydropower, but until the viability comes to actually get that energy out, you can actually monetize the energy, because the Bitcoin miners they can go and sit exactly where the energy source is. You don't need to have transmission lines, and so yeah, I think once you start looking at the whole energy factor, you can actually see the energy is a huge positive for this whole network.
Ian, thank you, guys. That's unfortunately all we got time for. I think we've answered just about all the questions. Andre, I think you want to buy Luna because Rassi is promoting it. But Ian, thank you for all the work you've done on this and your insights. I know you've done a ton of work in the background to give us this educational information. So thank you for that. Guys, and we look forward to seeing you again on the 16th of April.